There's a story in the Financial Times here that falls into the category of watch this space very carefully. There are certain leading indicators. Back in 2007, I was talking about the collapse in housing prices and how this was not a good thing. This could take down the economy. And turned out I was right. And now, I've been saying, look, watch corporate bond funds. We're seeing the bubble reinflated over the last 7 years, and it's been reinflated in large part by banksterism, for lack of a better word. By companies doing mergers just to jack up their share prices, by companies doing stock buybacks. Over 90% of the low interest rate money that was borrowed by big corporations in the last 7 years, which should have been used to expand operations and hire people and build new factories, over 90% of it was used for stock buybacks so that they could inflate stock prices and increase the compensation going to the CEOs and the largest stockholders and the senior executives. So we've got this problem, which is that the bubble may burst. I mean, Donald Trump said it last week, right? Or the bubble may crash, which is to quote Donald Trump, and also the title of my book, The Crash of 2016. And so the question is, what is the leading indicator? And as I pointed out, there's this massive amount of corporate debt out there. It's over $50 trillion in the United States. A massive amount of corporate debt out there, which, by the way, is 3 or 4 times the GDP of the United States. And that corporate debt, it takes the form of corporate bonds, and there's what are called high-yield bonds, which are often referred to as junk bonds. In other words, corporations who have a sketchy enough credit history that they have to pay higher interest rates in order to get people to loan them money. And then there's, the investment-grade bonds, the AAA bonds, and there's a lot of those out there. And those are bonds of, the traditional companies that are considered stable. And what's happening is that in both cases, when people buy into these exchange-traded funds, these ETFs, these funds that say, okay, if we've got $1 billion in our fund, we'll buy $1 billion worth of corporate bonds. But if we've got $2 billion in our fund, we'll buy $2 billion worth of corporate funds. So you put money into our fund, and you're essentially buying corporate bonds. The problem is when you take your money out of their fund, they have to sell those corporate bonds. And if they can't find buyers for those corporate bonds, then they can't pay you back your money. This is called a liquidity problem. Liquidity meaning they got the cash to pay you back. And if enough people start redeeming their money out of these funds at a fast enough rate that the funds can't sell off their bonds, particularly as people are losing faith in corporate bonds, they're looking at a crash coming down the road, then these bond funds, this could be a massive disaster, particularly since most of these funds, to the best of my knowledge, none of these funds are actually federally guaranteed. So if you're out, you're out. This is Robin Wigglesworth, the U.S. Markets editor. The headline, Fund Failure Exacerbates Liquidity Fears. Corporate debt has been one of the slam dunk investments, writes Robin, of the post-financial crisis era, handing investors juicy and stable returns. As a result, billions of dollars have gushed into the market, but some fear the party is about to result in an epic hangover. And then, it goes on from there with charts and graphs and all kinds of stuff. But if there's one thing to keep an absolute eye on right now, it's these corporate bond funds and how they're doing. And as their value starts to drop, and as corporate interest rates start going up, and as more and more companies in the United States declare bankruptcy, particularly in the energy sector right now because of the policies of Saudi Arabia keeping the price of oil low, we're getting into one of those times where it's probably a good idea to be very careful, as they say. Be very, very careful. To watch more clips from our programs, hit the Watch More Videos button over here. And please be sure to hit the handy-dandy subscribe button so you'll always be up to date. Tag, you're it.